financial markets could be in for a jolt as a major Dutch pension overhaul threatens to shake demand for key fixed-income assets. What the ECB is warning about. The European Central Bank is cautioning that the Netherlands' planned pension reform could trigger a wave of selling in long-term government bonds and interest rate swaps. These are core instruments used by large investors to manage risk and secure predictable returns over many years, so a shift in demand can ripple through broader European markets. What is changing in the Dutch system? Dutch pension funds are moving away from the traditional defined benefit model, where retirees are promised a specific payout, to a defined contribution setup, where benefits depend on how much is paid in and how investments perform. This change is intended to make the system more flexible and sustainable for an aging population, whose longer life expectancy and different work patterns put pressure on old guarantees. How this hits bonds and swaps. Under the old defined benefit structure, funds typically bought large amounts of long maturity bonds and used interest rate swaps to lock in future obligations and hedge interest rate risk. As these funds transition to defined contribution plans, they may no longer need the same volume of long-dated bonds and swaps, leading to weaker demand and potential selling of existing holdings. Why this could be controversial? A significant drop in demand for long-term bonds can push yields higher, raising borrowing costs for governments and potentially unsettling markets beyond the Netherlands. Some will argue the reform is necessary for long-term pension sustainability, while others may worry that moving investment risks onto individual savers and jolting bond markets at the same time could backfire. A question for you. Should policymakers prioritize modernizing pension systems for an aging society even if it risks short-term market turbulence, or should financial stability come first, even if that delays reform? Do you see this shift to defined contribution pensions as a smart modernization or a risky transfer of uncertainty onto future retirees? Where do you stand?